The Precious Metals Week in Review, June 17, 2016. Brought to you by Precious Metals International. Uncertainty continued to rule international markets this week, as further polling showed an increasing chance that the citizens of the United Kingdom (UK) might vote to leave the European Union (EU) next week. The number of Americans filing initial claims for state unemployment benefits surged by 13,000 claims to a new seasonally adjusted level of 277,000. California and Pennsylvania were responsible for most of the surge, and analysts were quick to say that seasonal quirks were likely responsible for the spike in claims in those states. We are not sure why the U.S. Labor Department chose the term seasonally adjusted to describe their official data figure if the seasonal adjustment factors in use do not account for the very seasonal quirks that they're now blaming for last week's surge. The U.S. Federal Reserve held its latest Federal Open Market Committee meeting to set monetary policy this week, and not only did they choose to leave interest rates at their current levels, but at the press conference following the meeting, Fed Chair Janet Yellen sounded like an interest rate hike was not likely to happen in July either, especially if the UK votes to leave the EU. Ms. Yellen directly referenced the so-called Brexit vote during her press conference, speculating that a leave vote could negatively impact the U.S. economy. One of the Federal Reserve's most hawkish members, St. Louis Fed President Jim Bullard, noted this week that low economic growth and an accompanying ultra-low Fed funds rate are likely to carry on all the way through 2018. The Bank of Japan BOJ held its interest rate steady at negative 0.1% and held off on further monetary stimulus on Thursday at the conclusion of its monetary policy meeting. The yen immediately surged higher on the news, driven in part by continued fears over the impact of the UK leaving the EU and what appears to be an increasingly inconsistent U.S. Federal Reserve. The BOJ said in its official statement on Thursday that the Japanese economy continued its moderate recovery trend with improvements in business investment, housing investment, and employment. Weak consumer demand and falling exports due to weakening global demand continued to put downward pressure on inflation and plagued the BOJ and Prime Minister Shinzo Abe's efforts to raise inflation to the target rate of 2%. At the press conference following the meeting, BOJ Governor Haruhiko Kuroda said that he was closely watching the movements in the yen, sparking analysts to speculate that a currency intervention may be on the table if the yen's rise continues. The Swiss Central Bank also left its negative interest rates unchanged this week, ahead of the UK referendum. The Swiss National Bank (SNB) said the imminent UK referendum on whether to stay in the European Union may cause uncertainty and turbulence to increase, when asked about any risk that it sees to the globally connected economy. The perceived risks to the global economy have triggered a recent rise for the Swiss franc, which hit a 2016 high against the euro this week. Christine Lagarde, the managing director for the International Monetary Fund (IMF), agreed with the SNB this week, telling CNBC that a decision by the UK to leave the EU is a concern not just for the UK, by the way, it's a concern for the world. Ms. Lagarde said, "It's a pretty overwhelming case when you have a huge body of economists that agree that it's going to cost the UK, it's going to be negative for income purpose, it's going to reduce trade most likely as a result of uncertainty, and those are blatant facts. When one economist disagrees with another, that's life. But when they all agree, that's a pretty compelling situation." Crude oil drifted back into the mid-$40 a barrel range this week, as polls continued to show an increase in the odds that the UK might vote to leave the EU on June 23rd. The uncertainty surrounding the upcoming referendum is affecting many markets, with volatility increasing as analysts try to determine what the impact of a vote to leave the EU could mean not only for the UK, but for the entire globally connected economy. The euro had a bit of a wild week, spiking higher at the week's open but then dropping straight back down. The euro began drifting higher again as Monday wore on, but by Tuesday had turned lower again. On Wednesday, the euro began moving higher again but had lost its momentum by Thursday and plunged to its lowest levels for the week. The euro's decline was short-lived and it soon climbed its way back to positive again by the end of the day on Thursday. The euro saw choppy trading on Friday, but still appears set to close the week slightly higher against the US dollar. The Japanese yen drifted slightly higher at the start of the week and then traded sideways through Thursday. Thursday morning, the yen surged to the upside on news that the BOJ held interest rates steady, but peaked early in the day and then began trading sideways to finish out the week. The yen will close the week higher against the US dollar. The US Federal Reserve seemed to lose what was left of its credibility this week when it refused to raise interest rates at its latest Federal Open Market Committee meeting. The Fed, the Bank of Japan BOJ, and the Swiss National Bank SNB all cited the looming referendum in the UK as their reasons for holding off on further monetary policy moves, and some of them even hinted that they could conduct outright intervention in their respective currencies to stave off impending economic disaster if the UK decides to leave. BOJ Governor Haruhiko Kuroda said that the BOJ is closely exchanging opinions with the Bank of England and other central banks. We want to coordinate closely with domestic and overseas authorities and carefully watch how the vote will affect the international financial market and the global economy, including Japan. SNB President Thomas Jordan told Bloomberg Television that officials could act in global markets to prevent any exaggerations. Stephen Barrow, a strategist at Standard Bank Group Limited in London, said in a research note to clients, "We'd expect major central banks to intervene to push back against this volatility. Policymakers will feel they already have the tools in place to try to limit wider disruption. Mass intervention by global central banks could spell panic for stock markets and currency markets alike, and next week will likely see a surge in volatility in those markets as the deadline approaches for the referendum. It is quite possible that stock analysts have not fully priced in the impact to multinational companies if the UK votes to leave next week. These same analysts may scramble to reprice their projections for stocks ahead of the referendum, triggering panic selling in the stocks of any affected companies. It will be important to closely monitor news outlets next week as Thursday's referendum approaches for potential impacts on market volatility. If central banks show signs of an imminent currency intervention, or if the global economy shows intensifying signs of stress, investors might flock to traditional safe haven assets such as physical precious metals in advance of the referendum. A sudden and dramatic increase in investor demand for physical precious metals could trigger a striking upsurge in prices as mining companies, nearly all of whom have cut their operations to save costs as prices have remained at suppressed levels, are simply unable to keep up. Next week will likely be difficult to sift through news for anything other than discussions of the UK referendum, so it will be important to remain diligent in your research for other news items which could be affecting prices of precious metals. It is the wise investor indeed that is prepared well in advance ahead of a sudden and dramatic upward surge in prices of the products they are looking to purchase for their portfolios. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products, and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, June 17, 2016. Brought to you by Precious Metals International.